Today, we're going to be talking about the sell off in financial data and analytics and examine whether there are bargains that are hiding in plain sight. Here's the setup. Ever since FactSet has reported its most recent quarterly earnings, the whole fin data sector has just sold off. And if you zoom out just a little bit more, it gets even gloomier. FactSet is down 38% this year. That's minus 53% against the S&P 500. S&P Global is down 17% compared to the S&P. Morningstar is down 48% compared to the S&P. And last but not least, the London Stock Exchange Group, or LSEG, is down 39% compared to the S&P. These are some really significant differences in performance. The type of stuff that can really set you back if you're a stock picker and trying to outperform the S&P 500 over the long term. But here's the thing. These are supposed to be high quality compounders. These are long-time Wall Street darlings. Shareholders love owning shares in these companies. They usually trade at premium multiples, and deservedly so. And if you zoom out on the stock chart, you can see that these look like traditional high quality compounders that have just hit a small patch of turbulence. So, anytime I see a cluster of quality names dropping in unison, my value antenna just goes up. Are there any bargains here? Is it time to make some money? And the fact that they're all going down together at the same time tells me this isn't a company specific issue. The market is reacting to some external factor and discounting future cash flows across the entire group of companies. So, what's this external factor? Well, you probably guessed it already. It's AI disruption. Thing is, AI is getting really good at a few things: retrieving and categorizing data, summarizing and reporting in just a few seconds, and just making analysts and portfolio managers just way more efficient. And so the big scary question is, who owns the user? If AI applications become the front door for research and portfolio workflows, does this mean that they will steal the direct relationship to the consumer that the incumbents currently have, like S&P Global, FactSet, Morningstar, and LSEG? That's what the market is starting to price in. Not that the data disappears, but that the value shifts towards the AI layers that control the experience, the user experience. And if data just becomes commoditized, then the pricing power of all these companies will just erode over time. So investors are just losing confidence and punishing this group of stocks. If you want a deeper view of the whole problem with AI, I'll let you watch my videos on FactSet and S&P Global. The link for the video should appear on the screen right about now. Today, we'll be looking at the last two companies in that group, Morningstar and the London Stock Exchange Group. But before we begin, let me just make an announcement. If you want full access to the RatedA portfolio, you can sign up to become a member today. You'll be able to see what we buy, when we buy it, the rationale for every trade, every buy and sell, delivered straight to your inbox every 2 weeks. That way, you can get some inspiration or just straight up mimic the moves if you want. So far, the RatedA portfolio is up 24.3% as of the start of October versus the S&P 500 that is up only 15%. This is dividends included. On top of all of that, as a member of RatedA, you will be able to get all of our research and all of our ratings. That way, you can be notified as soon as a high quality company goes on sale. So let's start off with Morningstar. This is a company that's involved in many types of different businesses. As you can see here from this chart, it's got 6 different business segments. But by far and away, the two largest segments, which are the direct platform and PitchBook, are both based on data and analytics. Under the direct platform, Morningstar just offers some software and datasets. There, Morningstar provides all the information you can ever imagine on stocks, funds, and other type of market data like ESG and indices and all that. They've got a whole bunch of ratings and other fancy intellectual property that they license to anyone and everyone in the financial industry, ranging from funds to research advisory firms. It's all subscription based and it's very sticky. Once they sign up a customer, that customer usually stays with Morningstar for a very long time. But the big problem in this segment is that there's just lots of competition. Morningstar is just a little fish in a big pond where the big fish are S&P Global, Bloomberg, LSEG, and FactSet. Also, as you can see here from the 2024 revenue trend, this is not a segment that's growing very quickly. It's pretty mature. All the funds, especially in Europe and in the United States, are already subscribed to some form of dataset provider. So this is not where Morningstar is going to find outperformance. The second segment is PitchBook, and here Morningstar also offers data and analytics, but this time it's geared towards private markets, and we'll get back to PitchBook in just a second. But the third important segment for Morningstar is credit. This is where Morningstar offers credit ratings. Now, as you'll probably know if you watch this channel, I really like this type of business model. It's just a toll road on the financial ecosystem. But once again, Morningstar doesn't really have an edge here. It's the fourth largest credit rating provider, but it's fourth by quite a large margin behind Fitch, Moody's, and S&P. Even if Morningstar is able to provide ratings at a cheaper rate than its larger competitors, usually companies and governments will tend to prefer going for the more expensive option with S&P Global and Moody's just because that gives them more credibility. Having said all that, the shining star in Morningstar's entire business has to be PitchBook. PitchBook was acquired in 2016 and it's been a really successful acquisition for Morningstar. It's turned their business around. As you can see from this chart, the growth has been rather extraordinary. And since 2021, this segment is actually profitable. From the yellow line here, you can see the margins are going up year after year. As this business scales, it becomes more profitable for Morningstar. This is exactly the type of setup you want to see in your successful investments. If we look at Morningstar's overall revenue, you can see that something switched right about here in 2016, 2017. This is where they acquired PitchBook. And since then, the revenue has been on a tear. And it's growing really quickly because private markets are growing very quickly. There's never been as many private companies. The number of private companies far outnumbers that of public companies. And if we look at the share of assets under management in the public markets versus the private markets here in red, you can see that every year the gap is closing. And for once, Morningstar is actually a leader in this category. PitchBook has one or two smaller competitors, but they are not nearly as used as PitchBook. So all in all, Morningstar is a pretty good business, especially thanks to PitchBook, but that's already reflected in the multiple, which stands at 28. A multiple of 28 doesn't really get me excited for this company because that already implies some level of growth, and PitchBook would really have to outperform in order to give me upside when the expectations are already this high. This is why our rating system here at RatedA is only giving a value rating of 33. To me, this is not near enough to the buy range that I like to use with many of the companies I hold in the portfolio. If we do a quick valuation exercise with the TSR calculator, which calculates the return you could expect over 5 years, based on some conservative assumption like 9% revenue growth, 17 free cash flow margin, and a terminal multiple of 25, I get a total shareholder return of about 11%. To me, that's not different enough from the market. For me, this would only become a good buy if the multiple drops down to the teens, but given this is Morningstar, I'm not sure the stock price will actually get there. And that's okay. There are other opportunities in the market. Next, let's do LSEG. This is a little known company, especially to American investors, but it's so important to the financial system. Similar to Morningstar, they have many different business segments that all do different things. Now, by far and away, the most important segment is data analytics. You might have heard of a firm called Refinitiv. They're often cited at the bottom of articles by the Wall Street Journal or Reuters, for example. They are a direct competitor to Bloomberg and FactSet and Morningstar, and they were acquired by the London Stock Exchange Group in 2021. So, if you're ever looking at this company's financials and you see a huge jump in the company's revenues, it's because of that. Similar to every single business that's in data and analytics, Refinitiv, which now calls itself LSEG Analytics, is extremely sticky. Once a customer is signed on, they very rarely switch to a competitor. And this is an important segment for the broader company, London Stock Exchange Group. As of 2024, it made up 47% of the entire company's revenue. And this is where maybe the alarm bells go off saying, if data and analytics is such an important part of this business, then maybe it's more at risk from AI. But LSEG is not just standing around with its hands in its pockets, it's actually leaning into this trend. A few months ago, LSEG announced a partnership with Microsoft, where all of LSEG's data is going to be readily available on Microsoft tools like Copilot or Excel. Think of all the giant global corporations that use Microsoft as their work suite. Well, LSEG is betting that for those companies that work in the financial sector and use Microsoft, it's going to be a lot easier for them and a lot smoother to use LSEG's data and analytics when it's directly connected to Copilot. Now, like I mentioned before, the London Stock Exchange Group has other segments as well, two of the next biggest ones being capital markets and post-trade. The company owns some unique financial assets that are extremely important, that are at the heart of the global financial ecosystem, like the London Stock Exchange, other fixed income exchanges, and like the London Clearing House. These are all extremely unique. They're not easily replicable. And even though they're not subscription based, they're more transaction, so more cyclical, more lumpy cash flows. They're still extremely important. They contribute to the bottom line, and most likely they will be higher 10 years down the line than they are today. Now, speaking of unique assets, the London Stock Exchange Group also owns an index franchise. And you know how much I like index businesses. They're extremely high margin, they're extremely scalable, they have huge moats, especially for the most popular indices. And London Stock Exchange Group owns some popular indices like the FTSE family, which if you're a UK investor, you'll be familiar with this one. It's the equivalent of the S&P 500 for UK markets. And potentially more important than the FTSE is the Russell. Now, this one, if you're a US investor, you will be familiar with the Russell. It's the index that's usually used to represent all these small caps and mid caps, basically a barometer for the broader market, not just the 500 largest companies. So, London Stock Exchange Group is a really solid business. All of its components are very strong. Yes, revenue has slowed down a bit in recent years, but the valuation is a lot less demanding. We can see that the free cash flow multiple today is close to 18. Now, out of all the companies we have covered in the past few weeks, London Stock Exchange Group by far has the lowest valuation or the lowest expectations. Based on that, and based on the company being rated very highly in terms of quality, the value rating today is really high. It's at 89. This indicates that this company is a buy. Surprise, surprise, this is one of the companies that I have been buying lately in the RatedA portfolio. If we use the same calculator again and I input some conservative assumptions like 6% revenue growth, 29 free cash flow margins, and a multiple of 25, then the implied return over the next 5 years is close to 15%. So I really like this company, and if I have to give my verdict out of the entire sector that we've covered, this is the one that I think provides the best risk and reward ratio. Okay, that's it for this video. Thank you for watching, and I'll see you in the next one.